Hi everyone, this is Ben, and this is your Belmont Math and Science Center tutor tip. So today we're going to be looking at a few different topics regarding intangible assets. In previous videos we've talked about depreciation, which is talking about what we do with tangible assets. So we're going to go over three different topics today. We're going to go over amortization, depletion, and goodwill, and how we expense each one of these over the course of their lifespan. So the first one we're going to work on is amortization. So we're going to do this practice problem to help us better understand what to do when we have an amortization problem. Company X secured a patent on a drug that will last for 10 years. The development of the drug cost the company $450,000. How much amortization expense will Company X record each year for these 10 years? And then finally, we'll talk about what is the difference between amortization and depreciation. They are very similar, but there is one key difference. So the first thing we need to do is we treat amortization like we do straight line depreciation. So that means we have our cost is $450,000. And then we divide that by, in this case, how long the patent will last, which is 10 years. Normally we would say, like in a depreciation problem, we would say useful life. But with amortization, we'll just do cost divided by length of patent or license. This is used for intangible assets like a patent, and that's how we will determine how much expense we should do for each year. So we'll do 450,000 divided by 10. We'll do that in Excel right here, and that will give us $45,000 every year. So if we were to journalize that, we would have amortization expense, and then we would have accumulated amortization. So again, very, very similar to a depreciation problem, right? Instead of depreciation expense and accumulated depreciation, we just have amortization expense and accumulated amortization. All right, so if they're so similar, what are the differences? So really the key difference, and I mentioned this at the top, is amortization is talking about an intangible asset. And this problem is a good example of that. So Company X secured a patent on a drug that will last for 10 years. So the reason why this is a valuable asset for the company is that this patent will allow them to sell this drug as their name brand and make them more money because they have the patent, obviously, and this can apply to licenses and other things. But there's really no piece of equipment or whatever to depreciate. So instead, we call that amortization. Depreciation is talking about a tangible asset, and a piece of equipment or something that will break down as we use it. Very similar concept. Like we said, cost divided by length of patent or license. Change that to or so it doesn't look like we're dividing. And that is what differentiates amortization from depreciation. So next thing we're going to do is look at a depletion problem. So depletion, very similar again to depreciation, but in this case, again, we're talking about something different than a tangible asset. We're talking about natural resources. So in this problem, we're going to start with Company X bought a piece of land filled with trees for $2 million. On the land, there is 500,000 square feet of lumber. It cost Company X $1 million to prepare the land in order to use the lumber. In 2020, Company X cut down 100,000 square feet of lumber. What is the depletion expense for 2020? So, a lot there. Alright, so as I mentioned, depletion is pretty much the same thing as depreciation, except for we're talking about it with natural resources. In this case, we're talking about trees and the lumber that they can provide. So the first thing that we need to do is figure out how much it costs us to not only buy the land, but also to prepare it so that we could use what is on the land. So if we're looking at the total cost, we have to add up not only the cost of purchase, but also the cost to prepare. All right. So to do that, we just simply have to add 2 million to 1 million, and that will give us $3 million. And once we have that, then we can go on to figure out our next step, which is figuring out our depletion expense for 2020. So there's 500,000 square feet of lumber in this land. So we got this big plot of land that has a ton of trees on it. So what we need to figure out is how much of that land, what percent did we take away, did we deplete during the year 2020 when we took 100,000 square feet of lumber off of the land. So how we can do that is we can do 100,000 divided by 500,000, and then we'll put that into Excel. There we go, divided by, there we go, and so that is 0.2 or 20%. Alright, so we depleted 20% of the land. So what we can do is, we had this cost of $3 million for this land and to prepare it, and we took 20% of the value off the land. So if all we have to do to figure out the depletion expense is we have to multiply the total cost times the percent lost off the land. So in this case, we have 3 million times 20%, and that'll give us our depletion expense for the year. So again, very similar to depreciation, we just have to do depletion expense. Oops. We have to do depletion expense as our debit and accumulated depletion as our credit. So again, this is talking about natural resources rather than a tangible asset like a piece of equipment, and that is why this is different. So the last thing that we need to do in terms of intangible assets is we're going to talk about goodwill. So goodwill is basically what gets put on a balance sheet when one company buys another, and they buy them, one company buys another company for more than that company was worth. So if company X bought company Y for $500,000, but they're really only worth $400,000, to balance the books, they would put $100,000 of goodwill. So there will be some problems when they'll ask you, company X's goodwill was impaired by $100,000, record this as a journal entry, and maybe they'll give other information, but really all you need to do is look at this number. This is actually a really easy problem. You just have to do impairment of goodwill for $100,000 as your debit, and then goodwill you are going to credit for $100,000 as well. Impaired basically means your goodwill has decreased, and if they give you an amount, you just plug that in, you credit that goodwill, that's Godwill, that would be incorrect, and you debit impairment of goodwill. Hopefully this video has helped you guys on intangible assets. If you need any help, I suggest emailing your professor, or if you need any other kind of help, we are more than happy to take you at the Math and Science Center. Thanks, guys.